Okay, so let me hide the controls. Okay. Uh, Now, this is the MetaTrader software. Once you have a trading account logged in, you should see it like this on your left. I'm not going to go into very basics of MetaTrader on my YouTube channel. You can see I think I have a very quick introduction for the MetaTrader. And I also have a 10 minutes how to do a trading strategy testing. Is also on my YouTube channel, Matlub Khushi, if you go and have a look. So the concept, I'm going to give you quite a few different basic concepts of trading and the work and the trading book. So when we go and place an order, press F9, or you can go from the menu as well. You can see here are two prices hovering a little bit up and down. At the moment, the asset class we're looking at is a BTC USD, it's a Bitcoin. So now this is very important to understand. If I buy the market, which price my trade going to get executed is a higher price, not the lower price. So my buy by market will get executed on this higher ask price. And if I do the sell by the market, it it will get executed on this lower price. So that means I will be in disadvantage position, like I'll be losing money in between this bid and ask price. This is called spread. So whenever we go in a trade, we lose this money in between the bid and the difference between bid and ask price, which is called spread, right? So that's a market execution. There are other type of pending order, or in the cryptocurrency, it's called limit orders. We can set the certain price for order to get executed. So let's do mm, maybe let's do sell by market. I just want to show you how does it look like. Okay, not enough money. Try again. My point maybe 2.01. Sell by market. Yeah. So now the trade get executed. Now this is called the order book. Is my sell position. So this is called shorting the market. Without buying, I have sold the BTC in a hope for in the future the price will go down and I will make some money, right? So this is called shorting. This is my volume here. This is the price it got executed, and then I can set the stop loss or take profit. A price where if I go in a certain loss, then I can have my stop loss stopped, or if I get a certain amount of profit, the trade can get automatically executed. You can double click on this one and then you can do these settings here. The main thing to learn here is that I want you to learn. I'm not really teaching you the MetaTrader software. The main point I want to show here that it has an order book, and this order book has nothing to do with the real Bitcoin price. So that's the point I want to make to you. This IC market broker has his own book its own order book. As soon as we issue an order here, so IC market may have millions of users all over the world. So they are betting against each other. So the price should come up here. Let's see if we have price. Hide all symbols, and then I can see the price, BTC price. Okay, you see now. You see the price is continuously changing. Let's make this a little bit bigger. So this is the spread, and this is the bid. This is the bid, and this is the ask. And if you can watch closely, the bid price is always lower than the ask price. So that means whenever we buy, we will be buying on a ask price. And whenever we will be selling, we're going to be selling at the bid price. And this bid and ask price has nothing to do with the real Bitcoin price. But why? Now this is sentiment, because broker said that this is the price of the Bitcoin, so automatically people will assume that this is an asset that's been tied with a Bitcoin. So if we look at the real Bitcoin price, this is a cryptocurrency exchange called MEX. And if we go to the, not in the future, with the spot market. So while it's loading, I can load the Binance. So you can have accounts in each of demo account in each of the exchange. I don't know, it's not working. Okay. If I go trade here, yes. So this is the real BTC price. 109608. This is, oh, sorry, this is the perpetual. This is not the real price. Uh, Let me see with, um, this is hot future. These are all future prices. Again, this future price is slightly different from the spot. This is spot. Yes, the spot price is the actual real price of an asset. BTC, Bitcoin. Now, now if you look closely, this is the real BTC price of a real asset. So it's 6345. When the market is volatile, usually you see the price difference. Now you can see up here, this is the price of the future, BTC in the future, and you can see the price is different here. There's almost a $40 difference. This is the BTC future price, yeah, and this is the real price. And now if you go to the MetaTrader, you'll see the price here is different, right? So the point I want to make, the real asset is this one, the BTC price in spot. In spot price, when this is the price where the seller is ready to sell their actual BTC on blockchain. And when and when a trade happens on spot, then the actual BTC get transferred on blockchain from seller to buyer, right? This is the important thing that you need to understand. Now, in the future, when we trade in the future market, then this price is usually very much correlated with the actual price. But when we trade in the future, no real Bitcoin get transferred from seller to buyer. And same here in the case of MetaTrader. Whenever we're doing the buy and selling, no real transfer is happening. It's just a betting between the seller and the buyer. And that is managed by this broker on its own book. Same here in the case of MetaTrader, same here in the case of future, whether it's a MEX market or whether it's a Binance or OKX or any other exchange. Uh, so the benefit of having a demo account in these exchange, you can add as many US dollar you can add. I've added here like 14, 1500 something. Um, if you want to add more, you know, you can add as many quantity as you want. I add, for example, 5,000 more here. Yeah. So this get added to my balance. Any questions so far?
Yes, can you repeat that one more time? Just to
Yes.
like clarify.
The main, the thing that I want you guys to understand the real price, or in the case of BTC, USDT, is its price in the spot. Spot, whatever price being shown here in the spot, that the real price of the BTC. That is the price where the people ready to sell or buy a real Bitcoin. So the here we also have the same thing by the bid and ask prices, but this order book is a real order book. Whenever a buy and sell happens in spot, then actual Bitcoin get transferred from seller to buyer on blockchain. When whenever you trade in the spot, the real Bitcoin get transferred from seller to buyer on the blockchain. And then you can transfer that with Bitcoin from Binance to MEX or any other exchange because you have a real thing in your hand. You can even transfer to that your laptop, to your phone, to keep it for your rest of your life. You can transfer it onto the USB wherever you want. It's like owning a Microsoft Word file, but you can't copy it. The only difference, I want you to understand if you're not much aware of the blockchain technology. It's like a file, Microsoft Word file. In this technology, the blockchain technology, you can't copy. You can't copy paste. There's only one file. When you transfer that file from one person to another person, whole file get transferred and you will have no copy of it. So that file you can put it on your phone, that file you can put it on your laptop, that file you can put it in the cloud. You can, as long as you have its private key with you, you own that asset. If you forget the private key or you lose the private key, even that asset is sitting on your phone or on your laptop, it's gone forever. You cannot retrieve it. So that is, these are all the things with the spot Bitcoin or any cryptocurrency, whether it's Ethereum, whether it's XRP, dot, you name it. If it's a spot asset, that means it's a real asset, you can transfer it anywhere you want as long as you have a private key. You are the owner of the private key, you hold. Whoever have the private key, he has the asset. That's it. Whereas when we trade in the future, this is the future. It says perpetual. Perpetual is a special type of future trading where there's no contract date. You can buy and then hold as long as you want. So this is a perpetual future trading. Here the price could be slightly different, which you can see in this case is a 109697, whereas the price in the case of spot is 739. So the price is slightly higher in the case of uh, spot, and in the future the price is slightly lower, 20 $30 for now. It can be other way around. The market is not moving much. When the market is very volatile mean the price is going up and down very fast, then this difference could be very different. Okay, same thing now. Whenever we're trading in the future, then this has its own its own order book. The order book that you see, this one, the prices that you see in this order book, bid and ask prices, they have nothing to do with the prices that shown here in the spot order book. This one is a spot order book. This one is a future order book from this Mexic exchange. And if I have a Binance, if I have a OKX, if I have any other, like for example, Bitgate has its entirely own order book. Yeah, there's a problem with I think they're not serving the UK customer. Okay. Yeah. So every exchange, how many exchanges out there? There's a website called Coin Market Cap, very important website. Everybody who do cryptocurrency trading, they use Coin Market Cap. There are a couple of other websites that provide the similar things. It provides you very important thing, the total market cap of the cryptocurrency. It has information of all the tokens, and it has a list of all the cryptocurrency exchanges, ranking. Let's look at the ranking. So you can see, why it's not going to show. Oh, sorry, I want to go into the exchange. Yeah, so this is the list of uh, cryptocurrency exchanges which provide the spot options. Binance is the top one. It has the most volume. And then you have the other listing here. As you can see, there are so many exchanges in the world. Hmm, So many. Let's go to a lower ranked exchange. Uh, I think once I used the Hitbit long ago. Hmm, I don't know why it's blocking me. Okay, try any other. Hit BTC. It was Hit BTC. Let's try Hit BTC. Yeah, I don't know why. Fox bit coming soon. Okay.
Oh,
So you
it
see there are
doesn't even is it for
sorry,
this.
say it again.
So some of this is changed. It doesn't is it yet? So
Yeah, there are so many new exchanges coming up, and every country is now bringing up the regulation. So in the cryptocurrency. So that's why this is a very golden period for you guys to get into this domain because now the real change in the world is happening right now. US has regulated it. Australia has kind of many countries have now regulated it. US has laws, UK have law, Australia has law. Dubai has a complete regulatory body. They have a complete ministry on the cryptocurrency. So the real now you will see the banks pop cryptocurrency banks popping up like this one. So many opportunities are coming up in this domain. It's very fast. So it's very important to understand the concept and get into this domain early on. Bit. Let's try this bit. Okay. Spot BTC. Let's see. So most of the exchanges provide you the spot trading as well. Now, this is a spot. Now you see the price here is slightly different and it's not very at the moment the market is not very volatile. When the market is very volatile, the prices could be very different. Now you can still see there's a slight difference of price here. You got 109,793. It suddenly got mashed up. So that means somebody has done the trade to match the price. So 806, there's a few dollar difference. You see, it's 793 here. Here is a 803. Few dollars difference of few dollar. So to benefit from this difference is called arbitrage trading. And that is what Henry been working on for last week or so, couple of weeks, I think. So what we can do, buy from an exchange where the price is small and sell it on an exchange where the price is high. But obviously we will have to pay the fee. So we wait for the moment when this difference is big enough to cover all the fees and we'll make some profit. And it happens when the market is very volatile. I use this word a lot. Volatile mean, this is volatility when the market is moving very fast. You see, at this moment, the market suddenly came down here again. So on these movements, you will see the price move so fast that different cryptocurrency exchanges cannot cope up with that, and the price difference happens. And we take advantage of that. This is called arbitrage trading. So you see, this one is a big wick within 5 minutes. Yeah, another big one drop. Now it's picking up. 912, 936. So there are exchanges out there. There are people out there who are doing this arbitrage trading with the millions of dollars. That's why the price catch up very quickly. It's a roughly $50 difference at this moment. And you see the price catch up because other people are doing a trading, and there's a cryptocurrency exchange called exchange on there. They do this type of trading, arbitrage trading. And there are other companies that do basically do the same thing, do this arbitrage trading. So Henry B is been one of his effort for last couple of weeks is finding the exchanges and pairs where we can take advantage of this price difference. And I've asked him to capture not only the price, but also the order book, the volume, the amount, and the BTC price. And then we can do something, apply some deep learning methods on top of it. Okay, so that's one thing. The other point so far that I want to make, that different cryptocurrency exchanges which are providing you the spot trading, they can have a slightly different prices. Whenever you're doing in the spot, whenever you're trading in spot, you're trading the actual real asset. But whenever you're trading in future, which is called perpetual mean it doesn't have an expiry date, then um, you just betting with other people. Like these are people who are betting against each other. And this order book has nothing to do with the prices with the spot. They are the people who are betting against each other. And that's why the prices here are always different from the spot prices again. Now, the project that we're going to do is very important to understand this thing, that this order book in the future market for the MEXC, they have their own order book. They have their own like database of these prices going up and down. This exchange bit will have its own order book. You see there's an option here, perpetual, which is a future trading. You go in there, go to the BTC, USDT, and you will again see different prices here, right? 110, 168, and the price on the MEX is 3.5, like roughly a difference of $150 against one BTC. So that's its own, is this exchange is its own order book. It has nothing to do with MEX, Binance, or any other exchange. That's their own. And MetaTrader, whatever trade that you're seeing here, they have their own order book. They have nothing to do with other. Any questions so far?
No. Cause I think kind of do, I already do this kind of trading by myself before, so I can understand all the process for this kind of trading. For the future trading, you're more like betting betting this price are going up or going down, and you can make a lot of money uh by this uh forecast, I think.
Hmm. Now we can do quite a few things. Predict the price based on the movement in the stocks because they are correlated. The prices are different, but they are correlated. As you can see, the prices have gone up to 332 now on this perpetual. That's on the bit. And the price has only moved slight, almost is the same thing. So basically, there's a lag in the price, lag in this exchange. On this one, 370. Now the bit has caught up with the price, But you can see there was a lag in there. We have just spotted that few seconds before there was a lag. So there are people out there who take advantage of this few second, like milliseconds of gap, execute their trades, make their profit. As soon as the price catch up, they come out of the trade. So they might have made only like maybe like $10, $20, whatever, but they will be doing this like maybe hundreds of time in a day. So this is called arbitrage trading, making benefiting from the difference in prices in different exchanges and different type of markets. So now the risk assessment that we will be doing. Now this exchange bit there when when you have an order book here, this is this is the bid price and this is the ask price. Right. So now if we issue an order here, we say we want to buy, like for example, I go on to Mexico, I issue an order. This is a demo account. Yeah, I say I want to open the trade. I'll probably just do a trade of 2000 with okay, let's do the 500 isolated trade. I The margin it's going to use is a $4. This margin will get subtracted from my this available balance. Okay, my order get executed. Now got a trade here. This is a trade in. So this is a trade that I issued on MEX, and this is a perpetual future trading. Now MEX or BIT or this MetaTrader platform, I issued a trade here. I sold and now I'm losing $10. Now these guys IC market, when I opened this trade, they had two options. They had an option to match my trade with the other person I was selling. So they could have matched my trade with another person who was buying. Option number one. Option number two, these brokers, IC market, they have liquidity providers. They have other companies who are providing them the bid and ask prices. There are companies out there. They provide this service. They are ready to buy or sell from you at any time. They are called a liquidity provider. So they have the option to forward my this trade to liquidity provider where my sell order could have been matched with their buy order. Right? Third option IC market had when as soon as I issue the trade, they take the chance themselves. They will they could they have the option not to forward my this trade to others, but keep this trade with themselves in their own order book. What's the benefit of that? The benefit of that, they will earn the commission and other things anyway. As soon as I close the trade in the loss, at the moment my trade is -8, as soon as I close it, hold this -8, hold this loss gone to whom? IC market. Money from my account got subtracted, and where the money is gone? To broker. Broker made all the profit. You got it? Any question here?
So not just the user are making this kind of trading in this exchange, right? So also the exchange will try to connecting to some other companies to do this kind of future trading, right?
Yes. Yes. So all broker do this. All brokers. Every single one from of them, they do it. Whenever you open a trade, they don't do it in this thing in spot, because in the spot they have to if you are a big exchange like Binance, yeah, they can do it, but not the small exchanges. But every exchange, every broker have this option. But that as soon as you open the trade, they have an option to forward your trade to others, or they keep the trade with themselves on their order book. The benefit of doing this, if you lose money, they will make money. So this is now a risk for the broker. If you make money, who gonna lose money? Broker.
Okay.
Yeah. So now our project is to do the risk assessment for a broker and to decide whether to keep this trade with themselves or let it go to the other traders. So let's call it A book, and let's call it the B book with the trader or with the broker, right? So maybe we can draw it. Basically, what we're doing, we like when you issue the trade comes in. So now you have two options. You or just say forward to. That was my one option. The other option was right. So let's call this A book. No, sorry. Let's call this one is a B book. B book like broker book. And let's call this A book.
For the B book, is it means like we take the risk uh, to the broker?
Yeah.
Is it? Uh,
So if I am the trader, I issue the trade. This is, this is a person who starts the trading, issue the trade. Now the broker has two options to forward this to the others, to a book. That means in that case, the broker will have no no extra benefit, right? So this is the broker trading system, broker system. If broker forward the trade to the other, broker will only make commission, which is a very small amount. But if broker keep that trade with themselves in their B book, if you lose, they will make a lot of money. But if you win, they will lose a lot of money. So there's a risk. You got it?
Yes. So I think the main problem is still how to forecast the future trending of the this kind of like BTC or something
Yeah.
to measure how it will goes going.
I'll get to that. How we will do it. I'll explain that. We can check the literature as well, how other people are doing. But I'll explain how we're going to do it. But you got the concept, right?
Yeah, for the people, it's more like taking the risk by ourselves, by the brokers, and for the A book, it more like
Hmm.
transform the risk to others, other
Yes.
providers.
So the same thing, when the bank provide you the loan, where the money come from? Do you know that?
Uh, Say from the someone who's saving in the bank.
Yeah. So then the bank do the same thing. So without realizing, actually is happening around everywhere, around us. When you go and take a loan from a bank, the bank do the same risk assessment. Bank and obviously first bank has to decide whether they want to give you the loan or not. We assume they decide to give you the loan. Now they have accepted your loan application. Now the loan they're going to give you, whether it's a loan against your home or a car loan or just a cash loan. Now bank has two options, whether to give that money straight from their own pocket. They are rich people, they're rich organization, they have the money. Or they take the loan from the government and then pass it on to you. Yeah. So taking their small commission. They have the same. So they have to do this risk assessment. It's the same thing. They do it internally without you knowing it. Yes. So if you are a good customer, you keep paying back. They make a good amount of money against your interest. But if you're only taking small commission, then there's a small money for them. So more risk, more reward. But if you run away with the money, you bankrupt, then bank will lose the money, could lose money as well. So that's a risk. The way we're going to do it, we let me open up Colab. I started doing something. Okay, we're doing the risk assessment in this case for the BTC future prices. So first we will simulate the BTC price. For that purpose, we can simulate BTC price by many methods. Uh, because the BTC price is very volatile, I've choose this Hexton method. It We can do the stochastic motion, we can do the Brownian motion. There's a good learning on how to simulate BTC price. Yeah. So, and that's something that can go into your thesis as well. Do we have, yeah, this one. Okay, first I'll just show you the first piece of the code. So every time I run this piece of code to simulate BTC price, you will see there will be a very different price pattern. At the moment the prices was like this. Now you see, now this is the price, BTC price starting from 100,000, and I gave him the 100,000. I only gave him the starting point, and then all these prices get simulated. So the suddenly price go a little bit up and then down and then up, down, up, down, down. So this is all simulation. So every time we run this piece of code, you will have a different BTC price and a different variance as well.
Uh, so is it based on the historical data?
No, no, it's not on historical browser. So that's why I like I don't want to use the historical price because the price we are predicting future. In the future, the price can go in any direction, and we are working with a risk. So in this part of the project, like we will do multiple things. So this part of the project, we are estimating how much risk we can take to make money. Right? Like in this model, price people are doing trading all the time, whether the price will go up, whether the price will go down. Yeah, people will be doing trading all the time. Now the broker has an option. So let me write this a broker here. So broker, this is the decision, this is the trade. Let me maybe write it here, or let's call it broker decision. So basically the person trading, whether the price go up, go down, whatever happens to the price, people will be doing trading all the time. And the broker has to do this decision all the time, whether to forward this to risk to the others, a book, or whether this keep this risk with them. If they keep with them and people lose, broker will make a lot of money. Yeah. Oh, I want to say broker, not broken. B book. So the broker want everybody in a B book to lose the money. Then that all money will go to the broker. Broker go rich and people will go broken. Right? So that's why you sometimes you see the volatility in the prices, major brokers shaking the price to make people lose their money. And people who are running these books, they have a billions of dollars and they can shake the markets up and down because they have a lot of trades opened in their book, and if you lose money in their book they will make money. Now now the broker, every time a trade opens, broker has to make a decision whether to forward and not to forward. So that's why the first part of our code is to generate the BTC price. And every time you run this code, a different BTC price will be generated. Make sense? Any
Yes.
question?
So I'm still confused about how to generate this kind of uh trending of the BTC price.
No, the code is already there. You don't have to. This is
Okay.
this is the code. Every time it's generating the BTC price.
Okay.
The code is here already here. Yeah.
So
This is
by running a million times, and uh, we can set up we can understand every time when the trading is match up the trading we simulate.
yeah.
Oh,
So yeah, so every time we run the code, we get a different BTC price. You see, every time we run, this is the variance, this is the BTC. Every time we run the code, the BTC price is different. And then now people start doing then we simulate the trading. Now this is another piece of puzzle. I used the chat GPT to generate this code, and there are some bugs in this code yet. So then I built a full trading system, tried to build it. The code is not complete, and that's where you guys comes in. You will understand the problem, and then you try to understand the code. You can generate your own code, use chat GPT. Claude.ai, I think, is better in generating the code. So your role, that's where your role comes in. So what you need to do at the end, every time we run the code, we'll have a different BTC price, different volatility, and then we'll have the number of trades, and then we will do how many days the trade period. In this one, like I executed roughly 18,000 trade, that many trade got closed. Initial BTC, that final price, and then we will. This is a book. How many trades got into a book, and what was their? How many people made profit? How many people made loss? So randomly, we will simulate trading behavior, and we can actually. I haven't tried it. Let's ask the chat GPT. Let's ask this chat to GPT. I'm simulating. Okay. If you know a better way of writing the prompt, let me know. Act as a uh, Python quant expert. Okay, what do you think? This is the prompt, and I just made up this prompt. I haven't tried this prompt before. Act as a Python quant expert and write me a code simulating um, trading behavior of real trader historically with my own experience with the trading. What I observed that most traders psychology is that they will take small profit but hold the losing positions. So now I don't know what kind of code it's gonna generate. I hope you got the idea. Let's run this code. Okay, maybe we can try running here, see what it does. I'll make a group on WhatsApp and then I'll share this code over there. Do some brainstorming, do some thing, and then we'll see how we go. So in this part of the project, we will be simulating people's behavior, and then we'll try to estimate how much money, if we have a 10,000 or 100,000 traders doing trading on our platform, and if we are the broker, what are the chances of losing their trade or making the money out of them? So you get started, and then I will give you some rules by which we want their trade to be opened on B book. When to open the trade in A book and when to open in the B book. I'll give you some rules around that. The rules came from industry basically. I had some meetings with industry people. So we want to simulate what should be their pattern, when to decide whether to keep this trade with themselves or forward it to the liquidity provider. Okay, any questions so far?
No.